Imagine looking at two investments with the exact same price tag of $50. One is a genuine bargain. The other is dangerously expensive. The upfront price tells you very little on its own. Let's step away from the stock market for a minute. Imagine walking through your neighborhood and seeing a local bakery up for sale. The current owner is asking $100,000 for the entire business. How do you decide if that is a fair deal? You cannot make a decision based on the asking price alone. You have to walk inside, sit down with the owner, and ask how much actual cash profit this bakery generates in a single year. The owner opens the books and shows you that the shop makes exactly $10,000 a year in profit. Since the asking price is $100,000, you are paying 10 times the bakery's annual earnings. Buying a stock works the exact same way. When you buy a share, you are buying a tiny slice of a real business. The true cost is the amount you pay for every dollar of profit that business makes. In the stock market, we call this the price-to-earnings ratio, or PE. To calculate it, you take the stock price and divide it by the earnings per share, the profit the company makes for every single share. If a stock costs $20 and the company earns $2 per share, you have a PE ratio of 10. Many beginners assume that a low number is always a great deal, and a high number is a mistake. We can see how this works on this chart tracking future expectations. A high PE ratio, say 40, 50, or even 70, appears when investors expect a company to grow its profits quickly. They are willing to pay more today because they believe profits will be much higher in the years to come. Tesla, for example, has historically traded at PE ratios well above 70. Investors aren't buying it because it looks cheap right now. They are paying for the expectation that the company will dominate its industry in the future. On the other hand, a low PE ratio of 8 or 10 gives you two possible scenarios. Either the stock is undervalued and you have found a hidden bargain, or the company's profits are shrinking and investors are moving their money elsewhere. The PE ratio measures investor confidence. It tells you how much the rest of the market is betting on a company's future success. Looking at a single company's PE ratio without comparing it to anything else won't help you understand its value. Here is a line graph showing our first point of comparison. You need to check the company's current PE against its own historical average over the last decade. If a stock averages a PE of 20 over 10 years, and today it sits at 35, it has become expensive compared to its own history. Now look at this bar chart comparing different industries. This is your second benchmark. Technology companies almost always run higher PE ratios than banks or energy companies. Always compare a stock to its direct peers in the same industry. Finally, we check the broader market using this historical gauge. This shows the PE of the S&P 500, a group of the 500 largest companies that acts like a thermometer for the health of the entire market. If this gauge hits 25, stocks across the board are becoming expensive. Layering these three comparisons together reveals whether a stock is actually worth its price tag. Even with these comparisons, the PE ratio has blind spots that can trap investors who rely on it too heavily. First, the formula ignores debt. You could look at two companies with the exact same PE ratio, but one might owe billions of dollars while the other has no debt at all. The ratio cannot show you that difference. Second, the standard PE ratio is backward-looking. It uses last year's profits. A company's business could be failing right now, but because it made money last year, the PE ratio will still look healthy. Third, corporate accounting can be used to hide the truth. Companies can use one-time adjustments to make their earnings look better than they really are, which makes a bad deal look temporarily cheap. Think of the PE ratio as your starting point. You need to weigh it alongside a company's debt and future plans before making a final decision. Here is how you put the PE ratio to work. Step 1. Find the number. Go to a free financial website like Yahoo Finance, type in a stock name, and the PE ratio will be listed in the summary. Step 2. Compare it. Run that number against the company's 5-year history, its closest competitors, and the average of the 500 largest companies. Step 3. Look for the why. If the ratio is high, determine what growth the market is expecting. If it is low, check if the business is actually healthy or if it is struggling to survive. Those identical price tags we looked at earlier are an illusion. Now you have a way to look underneath the price tag and see the actual value of the business you are buying. The PE ratio serves as a guide for your investigation. pointing you toward the right questions to ask before you commit your money.